bear market rallies and indicators. So this is looking at our market last year, roughly. You'll notice that we got these significant pullbacks and significant rallies, 15% here, 16% here, and then another sell-off was much less. And then we had a little recovery. Every time the S&P is going to this long-term trend line. It's hard to imagine how that happens exactly over and over and over again, but it has been. There are indicators that, we might be kind of at the top of one of these bear market rallies. This is something that we look at. It's called the MACD. It's a moving averages. And when it's high and it crosses, that tends to correspond with a market decline. You can see that they correspond pretty close to one another. We've been using that to help with one of our strategies where we go long and short. It's a very active strategy. And we implemented that in August, and it's been very helpful. You'll also notice that the RSI, Relative Strength Index, when it's high, that tends to be a sign that it's overbought. And when it's low, it tends to be a sign that it's oversold and it's due for a rally. So it's hard to use it exactly, but you can see that it does tend to correspond with these periods, but nothing's exactly perfect. There were periods like with this MACD, for example, where it was very hard to read. There was a lot of crossing, just a lot of volatility and very little momentum. So this is another indicator that we look at. It's called the VIX. It's the Volatility Index. Again, it works very much the same way. When it tends to go under 20, the purple is the VIX and the orange is the S&P 500. When it goes under 20 and the VIX is low, the volatility is low, people are complacent. That's when you tend to get your sell-offs. You see that every time that VIX has been under 20, you tend to get a sell-off. Now, how deep that sell-off will be and how long it'll last, it's hard to know. And it's also interesting to note that when you get over 30, it tends to be a sign that you might be coming to the end of that leg down. But that's not always true. You'll see in the next slide. But that's an interesting sign when you get to 30 that you might be due for a little bit of a recovery. Now, the recovery tends to be less. It's called lower highs and lower lows. We just got done with a recovery where it came down and came back up. And it was a lower high, which was very encouraging to some people. But it seems like it's getting rejected off this line again. And it seems like we're going to kind of come back down. You'll notice in previous market cycles that it's not completely uncommon to get a lower or a higher low before going down another leg. You'll see that kind of right in here. Came down. It didn't come down quite as much as it was before. Came back up, got rejected. It's kind of the same thing in here. Here came down, not nearly as much as it was over here. Came back up, got rejected, and then came way down. So it does tend to pull a lot of people into the market, especially the unsophisticated money, retail money. So that VIX is very interesting. In fact, one of the really traditional signs that you're at the end, and it's a great buying opportunity, is when that VIX gets over 50. It's called a market capitulation. It washes all hope out of the market, and people think it's the end. People think that it's never going to recover. Anybody who's going to sell, sells. That VIX goes through the roof. The market capitulates down, and once all hope is washed out, there's nobody left to sell. People start buying, and the lack of sellers and the presence of buyers causes that market to recover. What you'll notice is in 2008, there was a lot of volatility up and down until it finally capitulated. 2020 was a surprise to people. So it just came out of the blue. Whereas what you'll notice is that we have a very similar level of volatility that we had back here. In fact, it's been greater. It's been the most volatile year. Last year was the most volatile year for 70 years. Just incredible volatility. It was only down about 20% on the S&P. The level of volatility to get that 20% down was just historic. So, I would anticipate that we will see something like this before the market bottom is in. So that's what we really pay attention to. Another thing that can be a good signal is smart money versus dumb money is what they call it up here. It's this institutional versus retail. This is the what they call the dumb money or the retail. You'll notice when it's high and smart money is low, you'll notice you tend to have a market peak. And look at that, the market peaks at each of those periods of time. And as of January 2023, you can see it's not been this high since back in August where we got that huge sell-off. So that's been a pretty good indicator. When you get that, this is called FOMA, when people are fear of missing out. And this is called FUD, fear, uncertainty, and doubt. And this is exactly what Warren Buffett is talking about. Be greedy when others are scared and be scared when others are greedy. So the retail investor is greedy right now and the institutional investor is scared. And that tends to be a sign that, we're probably going to have another leg down. You can see these things line up. The VIX is under 20, the MACD is turning over, the RSI is high, retail investors are greedy. so on. And so that tends to be a pretty good indicator that we got another leg down. So you never know for sure, but I just want to give you a sense of the types of things that you can look at to get an idea, like a map of where you are in a market cycle. So the bottom line on it is we got a long ways to go. There's going to be a lot of volatility, and you want strategies that can mitigate, manage that volatility.